Okay, so at first glance, we know that this is a lease agreement, right? Frost Co. entered into a 2-year lease agreement with Anans Co. for this computer. And we see that we have this additional information about the lease payment amount and the present value of the minimum lease payments. But what is this question ultimately asking for? They are asking for the circumstances that would require Frost to classify this arrangement as a finance lease. In other words, what circumstances would meet one of the 5 criteria within the Bones mnemonic, right? Because if we remember correctly, when we're talking about the lessee, determining whether this is an operating lease versus a finance lease will be contingent on whether the terms of the agreement fall within one of the 5 criteria. Okay, so knowing the 5 elements within this criteria will be your sanctuary on the exam. It is imperative that we know this because if any of these 5 criteria are met, then we know that this agreement will be classified as a finance lease. Because what it's saying is that if any one of these 5 criteria are met, this will indicate that ownership has been transferred within the transaction. Okay, so going through the incorrect answer choices first. Frost does not have the option of purchasing the computers at the end of the lease term. Right? Why would that be incorrect? Well, the B in our Bones mnemonic is going to represent a bargain purchase option. So if a bargain purchase option exists, essentially what we're saying is that the lessee will have the option to purchase this asset at the end of the lease term. Because it explicitly says that they will not have the option to purchase it, by definition, this is the opposite of meeting the criteria. If the economic life of the computers is 3 years, so we're thinking about the E in our Bones mnemonic. So this means that the lease term must be 75% of the lease's economic life. Well, if the lease term is 2 years and the economic life is now 3 years, this is only 66.67%, which is less than the 75% threshold. Okay, so this is not going to work either. And finally, ownership of the computers remains with Anans throughout the lease term and after the lease ends. This will be incorrect because ownership will need to transfer in order for it to meet one of the 5 criteria, right? The O in the Bones mnemonic. By remaining with the lessor, by definition, it will not transfer. Okay, but if the fair value of the computers on January 1st, year 1 is $14,000, this would meet one of the 5 sets of criteria. Okay, so thinking about the N in the Bones mnemonic, the net present value of the minimum lease payments plus the guaranteed residual value by the lessee must be 90% of the fair market value in order for it to meet the N in the Bones mnemonic. Okay, so if the fair value is now $14,000 and we see in the fact pattern that the present value of the minimum lease payments is $13,000, well then $13,000 represents 93% of the $14,000 fair value amount, which is greater than the 90% threshold. So that's why this is the best answer choice.
So you've read through the question, and what's the first thing you should be thinking about? Well, when I read through, the first thing I realized is that Payne Company, they are the parent company because they're preparing the company's financial statements. And what's unique is that Payne, they have a wholly owned subsidiary, which means they have 100% ownership, and that subsidiary is located in a foreign country. Now it says they use the euro as their currency. So then the next few sentences, they talk about the exchange rate for $1 to euros. They give us the weighted average exchange rate as well as the spot rate, which is as of December 31st. And then they give us some information about the subsidiaries, assets, and revenues. But ultimately, in the last sentence, there is one key word that we need to pull out, and that is translate. And that broadly refers to the translation method. So basically, the translation method is when we have a subsidiary that has their functional currency that is in a different currency than the reporting currency for the parent company. So in this case, the functional currency of that subsidiary is euros, and then Payne Company as a whole, well, they report in US dollars. So we need to translate the financial results, right, meaning the assets and the revenues here, into US dollars for consolidation by the parent company. So we'll try to make this very simple, right? Let's first start by thinking about the currency we have and where we're going. So if we have euros and we need to get to dollars, right? Well, we need to convert our euros into dollars. The next thing is, what kind of exchange rate is provided? Well, when they give us what it is we're trying to get to in $1, meaning the base rate, and they give us how much of the euros we need to get to $1, right? That's known as an indirect exchange rate. And they give us the exchange rate for weighted average, which means throughout the year, as well as the spot rate at December 31st, right? And that's going to be very important because we'll use different rates for different types of financial statement accounts. Now, as I mentioned, right, depending on what type of account we need to convert, we're going to use different methods. And there's really three main rates that you might see for the translation method. That's going to be the current rate or the spot rate, and that's always going to be as of a specific date. And that's mainly going to relate to the balance sheet. And that's because the balance sheet is at a spot or point in time, right? So that's going to be for assets and liabilities. Now, the average rate, well, that's going to be for the income statement. And when we think about the income statement as a whole, right, it covers a period of time. Well, if we have revenues in the beginning of the year, revenues at the end of the year, we don't want to use a conversion rate or exchange rate that's only as of a specific time. So we'll take the average of the rate throughout the year, and that's the average rate that we'll use to convert. So this is the hard part of the question. Do we take the euros and either divide or multiply by the exchange rate? Well, since we are given euros and we have the indirect rate and we need to take those euros and go back to US dollars, we are going to divide. So for assets, we'll take the 1 million euros and we're going to divide by that exchange rate of 1.25. And again, because this is for the balance sheet, we're using that spot rate as of December 31st. So 1 million euros divided by 1.25, that means our assets in dollars is $800,000. Now, same calculation for revenue. We take the 2 million euros divided by 1.5, which is the weighted average because revenue is part of the income statement. And that means our revenue in dollars is $1,333,333. So those are the correct answers here. So if you're finding it confusing to decide whether to multiply, divide, trust me, there's people that have been doing this for 10 years and they still struggle to think about it. So really just try to understand which direction you're going. And if you come up with an answer, go, okay, does this logically make sense, right? So at some point it will click. So just keep practicing.
Okay, so at first glance, this looks like a lot of information to stomach. So we're going to scan through this question, and immediately we can identify that this is a question talking about long-term notes. So notes payable and notes receivable go hand in hand. So yes, it's easy to remember that notes payable and notes receivable will generally be considered long-term liabilities and long-term assets. And yes, they will generally both be associated with interest. There are certain buzzwords that we need to remember to really ensure that we prepare ourselves for these types of questions. Okay, so when thinking about those buzzwords associated with notes, one of the first ones that needs to come to mind has to be non-interest bearing. And we see here in this question that this says that these are non-interest bearing notes. Okay, so the fact that it's a non-interest bearing note for both of these notes tells us that the stated rate and the market rate have this discrepancy. Okay, so they only give us this market rate, but what we can assume is that the stated rate is much less than what is presented in the open market. Okay, and ultimately they want us to understand the amounts that are reported at the end of the year. Okay, so what is getting reported on the balance sheet for both of these notes? Okay, so you might be thinking about the effective interest method tables. How does the amortization of a discount impact the ending carrying value of the note, yada yada. So we don't actually need to worry about how interest or amortization of associated discounts will impact the carrying value of either of these notes. And the reason is because these notes were also issued on December 31st. So no time has passed and therefore no interest has been accrued. So the day one value of these notes will also be what is reported on the December 31st balance sheet date. Okay, boom. Now that we know what it is we're looking for, we need to remember more buzzwords. So thinking about both of these notes that were received by Key, let's start with Omega because this one's a little bit more straightforward. Okay, so we know that this is a note that is due in 2 years, and it is not made under customary trade terms. So right out of the gate, we need to remember the difference between using the face value versus the present value when valuing these notes. The present value is going to be used when it is a long-term note, which is 12 months or more. So we're going to be thinking present value. Right? This note is due in 2 years. So therefore, we're probably going to be applying the imputed interest rate. So we also need to be mindful of the reasons why we wouldn't use the imputed interest rate. So we would not use the imputed interest rate if this was a note presented under customary trade terms and it is 1 year or less. Okay, so the Omega note does not meet that criteria. right? And the reason is because it's due in 2 years and it is not presented under customary trade terms. Okay, so anytime you see customary trade terms, ordinary trade terms, usual trade terms, and it is considered short term, then we are not necessarily going to use the present value or the imputed interest rate. Okay, but again, not the case for Omega. So what does that mean? Well, now we know that we are using the present value to determine the beginning and therefore the ending carrying value of this note. So when making this determination for the present value, we need to look at the present value factor. Okay, so the present value of $1 that is due in 2 years at 8% is 0.857. We know that this is the present value factor that we're using because we're thinking about the present value of $1 due in 2 years. Right, that's aligned with the note associated with Omega. Okay, so we're going to take the $10,000 note and we're going to multiply it by the associated present value factor, 0.857, and that gives us $8,570. That is Omega's present value. Okay, but the note from Alpha was due in 9 months, and it was made under customary trade terms. So when we're thinking about whether we're going to use the face value or the present value, we need to remember that short-term notes will be valued at face value if they are less than 1 year. And what also gives this away is that it says that the note is made under customary trade terms. So if we remember when not to use the imputed interest rate, we also remember that we're not going to use the imputed interest rate if the note is customary, ordinary, usual, all of those words work. And they do not exceed 1 year. All right, so when it comes to Alpha, we're going to value this at its face value. Okay, because it is short term and it is made under customary trade terms. So Alpha is going to be valued at the end of the year at $10,000 and Omega is going to be $8,570.
So in this question, we're focused on goodwill impairment for a public company. Now it's talking about the impairment test. And we should know that a company must test for impairment of goodwill at least once annually. That's the general rule that we must remember. Now, there's a little caveat to this rule that says as long as we test it annually, it doesn't matter when we test it, we just need to be consistent on when we test it each year. So if last year we tested it on June 30th or in June, we should test it in June or on June 30th again in the current year. If last year we did it in June and then this year we did it in September or December, that's not a consistent time period each year. So all US GAAP says test it annually, but be consistent on when you test it. So when we look at the two dates that are scheduled in these options, we should be looking for an option that has dates that are at the same time each year. And there's only one that has that. That's when it says year 1, April 15th, and then year 2, April 15th. It doesn't matter when we test them during the year, but as long as we're consistent on that month or date within each year, right? We look at the other ones, they're all over the place in terms of when they were tested last year versus this year, right? So just keep that in mind at least once annually, but be consistent on when it's tested. So the correct answer is year 1, April 15th, and then year 2, April 15th. So first things first, right? What stands out to you? Well, what stood out to me was that Prestige Worldwide, they own 90% of Alaska's common stock and they own 80% of Hawaii's common stock, right? So when we think about what's required of Prestige Worldwide, well, since they own more than 50% of both Alaska and Hawaii, then we know that those are considered subsidiaries that need to be consolidated into the parent financial statements for Prestige Worldwide. And how do I know that? Well, in the bottom left, we have a great visual, right, that tells us what to do with those subsidiary investments, right? So as we can see, they must go ahead and consolidate those entities. Now, what does that mean? Well, we need to eliminate any intercompany transactions, right? So anything that is between Alaska and Hawaii, that needs to be eliminated. Otherwise, it's a gross up and it would materially misstate the financial statements, right? Potentially. So let's go ahead and figure out what the intercompany transaction flow is in the organization, if any, right? So as we can see in the visual on the top of the screen, basically Alaska sells to Hawaii 100% of their product, right? So 100% of sales come from Alaska. Those are going to Hawaii and those would represent intercompany sales. So that's going to be $130,000 of sales from Alaska to Hawaii. that we need to eliminate. And then Hawaii, well, they sell to the end customer. And the end customer is going to be those individuals that are partying on the beach, right? So we can see that. So if we look back to the selected year one information, right, we see that Alaska has sales of 130,000 and then they have cost of sales for 100,000. And then Hawaii, well, they have 91,000 of external sales to the end customer. And then they also have cost of sales of 65,000. Now, what we need to understand is if Alaska sold the product to Hawaii at a markup. And since sales do exceed cost of sales by 30,000, well, there's definitely a markup there, right? Meaning they added on profit when they sold it to Hawaii. So that means that the cost of sales for Hawaii include a markup from Alaska. And we need to eliminate that since these subsidiaries are going to be consolidated. So at the end of the day, what we need to do is take sales from Hawaii, which is going to be the 91,000, and then we need to figure out what percent of the inventory that was actually sold and what that cost, right? And that's going to be based on Alaska's cost structure and not Hawaii's. Because ultimately what we need to do in this question is figure out what the reported gross profit is for both of those entities combined. So let's start with step number one, right? We need to figure out what percent of the inventory that Hawaii bought was actually sold to the customers. Well, if they purchased 130,000 from Alaska, right? Because that's the sales for Alaska, and then they sold $65,000 worth, well, that's 50% of the inventory. So that means 50% of the inventory was sold and 50% of it remains in inventory. So this is where most students get tricked up, right? What's the next step? Now that I know that Hawaii sold 50% of the inventory that they purchased from Alaska, well, what we need to do is take that ratio, that 50%, and apply it to the cost of sales that Alaska reported, right? Because if that's ultimately what it cost the overall company to produce that inventory, well, that's what it's going to cost for the actual combined financial statement. So 100,000 times 50%, that means the cost of sales for that inventory that was sold to a third party is $50,000. And then 50,000 of that product also remains in inventory. So now when we go to calculate gross profit, right, we go back to Hawaii customer sales because that represents sales that were actually to the third party customers. And then for that product that was sold, well, it's not $65,000 of cost of sales, right? It's only going to be $50,000 because we had to remove the markup that Alaska charged Hawaii. So at the end of the day, the gross profit on the combined financial statements for Hawaii and Alaska, when they're consolidated into Prestige Worldwide, that's going to be consolidated gross profit of $41,000. So now that we know that $41,000 is the correct answer, I'll pop up the journal entry in the bottom right. And as you can see, well, the debit would to be to sales, right? To remove that 100% of Alaska sales. And since we debit sales here, right, that's reducing it down to 0 for Alaska. And then for Hawaii, that 91,000, that stays. And then cost of goods sold, right, that's going to be a credit because that's going to reduce cost of goods sold. And mainly what we're doing here, we're taking $65,000 from Hawaii. That's going away, right? And then for Alaska, there's only $50,000 that should be flowing through. So 50,000 plus 65,000, that needs to be eliminated. That's how we get to 115,000. Now, if there's only $50,000 of actual inventory left, right, and Hawaii is showing 65,000 on their balance sheet, that difference is 15,000, and that's profit in inventory. So what we need to do is we need to credit inventory for 15,000 to bring Hawaii's ending inventory down to 50,000. So that's the journal entry. Now I know this is one of the hardest intercompany elimination questions or consolidation questions that you've probably seen. So in the bottom of the text solution, there is an Excel worksheet that has the combined elimination, right? Go in there. I've got all the formulas to show you how I figured out the answer, as well as the link to the journal entry, right? So this is a really great question to test your understanding of consolidations.